Welcome back, everybody, to the complete beginners course for ICT students. This video, we're going to cover fair value gaps and how to anticipate them, what they look like, and how to utilize them. So, introduction to fair value gaps. What is a fair value gap? A fair value gap is a range in price delivery where one side of the market liquidity is offered and typically confirmed with a liquidity void on the lower time frame charts in the same range of price. Personal definition: fair value gaps can be seen as a pocket in price delivery, otherwise referred to as an inefficiency in price. So those definitions, they may be a little confusing, and I will show you with a chart example what it looks like. Different types of fair value gaps. So ICT has two different terms for fair value gaps. So make sure you do write these down. Example, a bullish fair value gap would be called BISI, B-I-S-I, buy side imbalance, sell side inefficiency. A bearish fair value gap, SIBI, would be called a sell side imbalance, buy side inefficiency. What do these terms mean? These terms mean that for a SIBI, only sell side has been offered and buy side has not yet been offered. Vice versa, for a BISI, only buy side has been offered and sell side has not. So in the next slide, it will clear some of the questions you probably have. How do I use fair value gaps, otherwise the acronym FEG? There are multiple uses for fair value gaps. We can utilize them for entering into the market, exiting the market, or even using it as a guide for where price should go. Where can I find FEGs, fair value gaps? Fair value gaps form on every single time frame. You will use them together to create a bias. So they will form on every single time frame, and I'll teach you which time frame you should typically look for them to enter into the market and which one is more or less a higher probability fair value gap to look for. What fair value gap should I use to enter into the market? A fair value gap alone doesn't give you enough information to enter into the market. There needs to be other surrounding evidence to make that fair value gap valid. Throughout the rest of the course, you'll be taught which one to use. So like I mentioned, I will teach you which one to utilize. So what does a fair value gap look like? Fair value gaps are created by three candlesticks. So you can see here, you have 1, 2, and 3. And this is what I mean by a pocket or a inefficiency in price. So typically you're going to see a fair value gap form when price is moving really fast. When it's moving up really fastly, you're going to see that a small pocket of price has been left open. It's basically an open area where price is not yet traded into. So on this run up, you're going to see on 3 candles that a small inefficiency from this high of that wick in here, from number 1 to the low of the candlestick of number 3, that there's a small area in here, right, that has not yet been traded to. So buy side, BISI, in the first slide that I mentioned, BISI, there's a buy side and then sell side imbalance. So buy side has been offered, but sell side has not yet been offered into it. So I'll show you in the next couple slides here what that means and how to utilize that. Same thing for, this would be a SIBI. So this is a BISI, bullish fair value gap, and this is a SIBI. So when you see price moving lower really rapidly, quickly, you're going to see a pocket of price where it is not yet traded to. So you can see between number 1 candlestick this low and number 3 candlesticks high, you can see that there's a little pocket in here. Okay, so that's what a fair value gap looks like. Examples of entries and stop loss placement with fair value gaps. So this is how we would utilize a fair value gap to enter into the market. So you can see here, much like the previous slide, you have 1, 2, and 3. So let's say the next candlestick, see, this is where price closed. Price opens up here and price trades down into this little pocket. So buy side was offered, and when price trades down on this red candlestick, that's what? That's sell side being offered inside of here, inside of the bullish fair value gap. So if I was looking to enter into the market and I see price trades up, creates a fair value gap in here, let's say price has been going in an uptrend and I'm looking to buy the market, I can see a fair value gap. This would what we would be calling a entry pattern. So if I see a fair value gap form and I'm already anticipating higher prices and I see price reach down into the fair value gap, I'm looking to enter inside of this fair value gap. And my stop loss would be going beneath the second candlestick. So if I'm entering into this, my stop loss would be going beneath this number 2 candle, wherever that low is. And I'd be targeting whatever buy side is above price. Vice versa, you can see price expands lower on the sell side of the curve, right? You have 1, 2, and 3. Fair value gap forms. Price closes here on the third candle, opens up on this candle here, trades up into the bearish fair value gap. I'm looking to enter inside of that because I'm already looking for lower prices. I'm looking to sell. So price trades up into it. I sell the market right in here. My stop loss goes above the second candle, and then you see price trade off lower. So this is how we're utilizing fair value gaps. We can, anytime it trades up into it or into it, I'm looking to enter in there. So here's a real chart example. So you can see number 1, 2, and 3. Fair value gaps are formed by 3 candles. So price moves up quickly. You can see price trades off a little bit higher. Doesn't always have to return back on the next candle after the third one. It can keep trading higher. Returns back into the bullish fair value gap. We're entering in long, right? Because we're already anticipating higher prices. So price trades back down into that pocket, offering sell side. Stop loss would go underneath this number 2 candle low. So it'd go underneath here, and then we'd be doing what? Targeting buy side. So any old high, like this high here, has buy side liquidity. So I'd be looking to place my take profit here. So price trades down into it and trades up into the buy side liquidity. Now this is a bearish example. We're going to be looking to sell. So we have number 1, 2, and 3 here. So from this low to that high there, you see how there's a pocket of price. Nothing is traded up into it yet. So price trades up into it. We're selling short in here, putting our stop loss above this second candle, and price trades off lower to attack what? Sell side liquidity. So our entries here, stop loss, take profits down here. Now, where should I enter inside of the FEG, the fair value gap? Your entries should ideally be within the 25 to 50% of the fair value gap. So anytime you see one and you're already anticipating higher or lower prices, all you should be anticipating is price trading into basically about 25 to 50% of the fair value gap. You want to see a little bit of the fair value gap left open. You don't want to see the entire thing closed in, because if you do see that, it's not necessarily a good sign, because if it leaves a little bit open, it means that price is in a hurry. It's in a hurry to get somewhere. So you can see in this example, you have number 1, 2, and 3. So from this high to this low, there's a little pocket in here. And I'm annotating of that fair value gap, I'm annotating the 25% of it, the 50% of it. And price trades down into the 25 and gets a little bit underneath the 50%. So your entries don't have to be perfect. It can be, at the 25% or even the 50% of it. And my stop loss is going beneath the second candle here. So we're entering in there, targeting buy side liquidity above this high there. Vice versa for the sell, you see number 1, 2, and 3. From this low to that high there, price trades up into the 25 and 50% of that fair value gap. We enter in, you could choose 25 or 50, and our stop loss is going above. I know this number is not right there, but your stop loss would go above this high here because that's the number 2 candle. And then our take profit is going at this low down here because that's sell side liquidity. Price trades away from it. See how it leaves a little bit of it open from that high to that low. There's a little portion open. That's a good sign. You want to see that because that means price is in a hurry to go somewhere. Can price trade multiple times into a fair value gap? Yes, ICT classifies this as a reclaimed fair value gap. So sometimes you're going to see price trade into a fair value gap once and then it just moves away from it quickly. sometimes you may see it come back into it a few times before leaving it. So this example, you can see the fair value gap is formed here. So this is our first candle, this red candle. Second candle is this quick movement up, and then our third candle is here. So you have this large pocket of price, and it dips down into it one time, moves away from it, and that could be your trade right there. You could just go for a quick move, or you're looking for a longer move, so you have to hold out for a little bit longer. Price comes back down into it a second time, and then you can see a third time, and then it finally moves away from it. And you can see I've annotated the 25 and 50% level. So this is what we would call a reclaimed fair value gap. So it's okay if price comes back into it a few times. Typically on the fourth or fifth time, if it keeps returning back to it, that's not a good sign. So I'm going to give a little piece of advice there. Typically, you want to see on the first or second try into it, especially the first one, you want to see it move away from it. Really, the third time is the last, point where I need to see price move away from the fair value gap in the direction that I'm looking. And then in here, we'd be targeting the buy side liquidity. So vice versa here, first candle, the green one, second one is the red one, and then the third one is this red one there as well. So that creates the fair value gap. Price moves up into it once, moves away from it, comes back up into it twice, moves away, comes back up into it a third time, and then finally it sells off to take the sell side liquidity pool in here. So you can see the 25 and 50% level. It's respecting those, and it's leaving the other portion open, which is good. So that's an example of a reclaimed fair value gap, and that encapsulates fair value gaps in a whole. We'll go over in later portions how to utilize these inside of a framework and how to utilize everything together. So I'm doing step by step, and by the end of the series, you'll see how to put this all together. So hopefully you guys have been enjoying. I'll catch you guys in the next video.